Most people in America spend their entire lives working for income, yet very few truly own the engines that create income. That difference decides who experiences financial pressure for decades and who builds quiet strength over time. Long-term value investing. The ownership-based wealth strategy is about understanding what ownership really means in the American economic system and how disciplined ownership shapes wealth across years, not months. Within the next few minutes, you will see how real ownership works inside public companies, how it compounds, and why patience has measurable economic power. In the United States, public companies represent pieces of real operating businesses. When someone purchases shares of a company listed on major exchanges, they are buying a slice of its earnings power, assets, and long-term growth. This strategy focuses on identifying companies that generate consistent cash from real products and services used by millions of Americans every day. Grocery chains, logistics networks, consumer goods manufacturers, medical equipment producers, industrial suppliers, and technology infrastructure firms form the backbone of the economy. These businesses produce measurable revenue, reinvest in expansion, and reward shareholders through growth in value and periodic profit distributions. Ownership means participating in that process. Long-term value investing centers on purchasing strong businesses at reasonable prices and holding them for extended periods. Price matters because paying too much reduces future returns. Business quality matters because only durable companies survive economic cycles. Time matters because compounding multiplies retained earnings over years. When a company earns profit and reinvests a portion into expansion, it increases its productive capacity. That expansion leads to higher earnings in future years. Shareholders benefit from this growing earnings base. Over 10 or 20 years, this effect can become substantial. Here is where many American investors misunderstand the system. Daily price movement often distracts attention from business performance. Market headlines focus on short-term fluctuations. Value investing studies revenue growth, cost discipline, balance sheet strength, competitive position, and management allocation decisions. For example, a nationwide retailer that steadily increases store productivity, improves supply chain efficiency, and maintains responsible cash management creates long-term shareholder value, even if short-term price volatility occurs. The underlying business performance remains the central driver of long-term results. Research in U.S. capital markets shows that a significant portion of long-term equity returns comes from earnings growth and reinvested distributions. Over multi-decade periods, diversified ownership in profitable American companies has historically outpaced inflation and wage growth. This occurs because corporations continuously innovate, scale operations, and capture new demand across industries. Ownership provides access to that productive growth. Income alone rarely compounds at the same rate as business profits that expand year after year. Long-term value investing requires financial discipline. Investors analyze financial statements, examine revenue trends, evaluate debt levels, and assess competitive advantages. A company with stable demand, recurring customers, and strong pricing power tends to protect profitability during economic slowdowns. Strong balance sheets allow companies to invest during downturns while weaker competitors struggle. That resilience often strengthens long-term market position. Over time, resilient firms capture larger market share. Consider a practical American example. Imagine a company that manufactures essential home improvement materials used nationwide. Housing maintenance continues regardless of short-term economic shifts. If the company maintains efficient production, disciplined spending, and consistent reinvestment into innovation, its earnings gradually increase. An investor who holds ownership through multiple cycles participates in that growth. Short-term price swings occur, yet the expanding earnings base supports long-term appreciation. That is ownership-based wealth strategy in action. Diversification strengthens this approach. Owning shares across multiple industries reduces exposure to company-specific risk. A balanced portfolio may include consumer staples, healthcare equipment, industrial services, energy infrastructure, and technology systems. Each sector responds differently to economic conditions. Combined ownership creates stability. When one industry slows, another may accelerate. Diversification protects capital while allowing participation in overall economic growth. Another powerful element is reinvestment. Many American companies distribute a portion of profits to shareholders. When those distributions are reinvested into additional shares, compounding accelerates. Over decades, reinvested profits can represent a meaningful share of total portfolio growth. This process transforms moderate annual returns into substantial long-term accumulation. The effect becomes visible only with patience and consistency. Risk management remains central. Value investors avoid companies with fragile balance sheets, declining business models, or unsustainable growth narratives. They focus on tangible cash flow and proven demand. Careful review of financial ratios, return on equity, and free cash generation provides clarity. This analysis requires effort, yet it protects capital from permanent loss. Ownership works best when the underlying business generates real economic value. The ownership-based wealth strategy shifts focus from speculation to participation. It views public markets as a gateway to real enterprise rather than a platform for rapid trading. It respects the American system of corporate innovation and recognizes that disciplined ownership in productive companies builds financial strength gradually. Long-term value investing demands patience, research, and emotional control. Those qualities transform ordinary savings into ownership of powerful economic engines. In the next section, we will break down the practical framework for selecting value-oriented companies, structuring a resilient portfolio, measuring intrinsic value, and maintaining discipline during market volatility. The structure is simple, yet the execution separates temporary participation from lasting ownership. The strategy rewards those who understand that wealth grows through productive enterprise and sustained commitment over time. True financial strength begins when income is converted into ownership of businesses that continue working long after daily effort ends. Long-term value investing. The ownership-based wealth strategy becomes powerful when structure replaces guesswork. Many investors understand the idea of ownership, yet few apply a consistent framework for selecting companies, managing portfolios, and maintaining discipline across economic cycles. This section delivers a practical roadmap built around measurable financial data, real American business structures, and long-term performance logic. The first pillar is business clarity. Every company operates within a specific economic ecosystem. Investors begin by understanding how a business earns revenue, who its customers are, and what drives repeat demand. A company that sells essential household goods across national retail networks operates within stable demand patterns. A firm providing mission-critical enterprise software to American corporations may operate with subscription-based revenue that renews annually. These characteristics create predictable cash flow. Predictability supports long-term valuation stability. The second pillar is earnings durability. Long-term value investors examine revenue growth over 5 to 10 years. They study gross margins, operating margins, and net income trends. Consistency across multiple years demonstrates operational discipline. Companies with stable or gradually improving margins often possess pricing power, cost efficiency, or strong brand loyalty. When revenue grows while maintaining profitability, retained earnings expand. Retained earnings fuel reinvestment, acquisitions, research, and infrastructure expansion. This cycle strengthens future earnings potential. Balance sheet strength forms the third pillar. Sustainable companies manage obligations responsibly and maintain liquidity. Investors review cash reserves, total liabilities, and debt-to-equity ratios. Companies that maintain healthy liquidity can withstand economic slowdowns and continue investing when competitors reduce activity. During periods of national economic contraction, firms with strong cash positions often expand market share by acquiring smaller competitors or investing in capacity while others retreat. Ownership in financially stable firms protects long-term capital. The fourth pillar is return on capital. Efficient companies generate strong returns on invested capital. This metric measures how effectively management converts shareholder funds into profit. High and consistent returns on capital signal competitive advantages. These advantages may include proprietary technology, distribution scale, brand trust, network effects, or cost leadership. When a company reinvests earnings at attractive returns year after year, shareholder value compounds efficiently. Valuation discipline completes the core framework. Even strong companies can deliver weak results if purchased at excessive prices. Value investors estimate intrinsic value by examining earnings, growth rates, cash generation, and industry outlook. While precise valuation models vary, the principle remains straightforward. Purchase ownership at prices that allow margin for long-term appreciation. This approach reduces downside risk and increases probability of satisfactory returns. Consider a realistic American case. A nationwide logistics company that supports e-commerce fulfillment continues to expand warehouse automation, transportation networks, and route optimization software. Revenue grows steadily as online retail demand increases. Operating efficiency improves through technology upgrades. Management allocates capital toward expanding capacity in high-demand regions. An investor evaluating this company reviews its revenue history. cash flow generation, capital expenditures, and competitive positioning against other logistics providers. If valuation aligns with long-term growth prospects, ownership may represent attractive value. Holding this position for 10 or 15 years allows participation in structural growth of digital commerce infrastructure across the country. Diversification remains a structural safeguard. A disciplined ownership portfolio might include consumer staples firms providing everyday products, healthcare equipment manufacturers serving hospitals nationwide, industrial automation providers supplying manufacturing plants, energy infrastructure operators transporting essential resources, and technology firms delivering cloud services to businesses. Each sector contributes differently to overall economic output. Combined exposure balances risk while capturing diverse growth drivers within the American economy. Portfolio construction requires position sizing discipline. Concentrating excessively in a single company increases volatility. Spreading capital across multiple high-quality companies reduces exposure to individual setbacks. At the same time, excessive fragmentation dilutes impact. Many experienced investors maintain focused portfolios of carefully selected businesses that meet strict quality criteria. The balance between concentration and diversification depends on risk tolerance and research depth. Time horizon defines success in ownership-based wealth strategy. Historical U.S. market data across multiple decades shows that long-term equity investors who maintained diversified exposure through economic expansions and contractions experienced meaningful cumulative growth. Market cycles include recessions, inflationary periods, technological disruption, and regulatory change. Companies with durable business models adapt over time. Ownership through cycles captures full economic expansion rather than isolated years. Emotional discipline separates long-term investors from reactive participants. Market volatility generates headlines and short-term price declines. Ownership-based strategy focuses on business fundamentals rather than daily sentiment. When underlying earnings remain stable and balance sheets remain strong, temporary price weakness can represent opportunity rather than threat. Emotional stability protects investors from selling quality assets during short-term fear. Tax efficiency also supports long-term accumulation. Holding investments for extended periods may reduce transaction costs and limit frequent capital gains realization. Compounding functions more efficiently when capital remains invested rather than repeatedly moving in response to short-term fluctuations. Ownership strategy aligns naturally with lower turnover and extended holding periods. Continuous monitoring remains essential. Long-term ownership does not imply neglect. Investors review quarterly and annual reports, track revenue trends, evaluate management decisions, and reassess industry conditions. If a company's competitive advantage erodes or financial discipline weakens, reevaluation becomes necessary. Ownership requires responsibility. Informed oversight preserves capital and ensures alignment with original investment thesis. Technology has increased access to research tools for American investors. Public filings, earnings transcripts, financial databases, and corporate presentations provide detailed information. Investors who dedicate time to studying primary sources gain clarity. Independent analysis strengthens conviction and reduces reliance on market noise. Knowledge builds confidence during volatility. Long-term value investing. The ownership-based wealth strategy also recognizes macroeconomic influence. Interest rate environments, inflation trends, labor market conditions, and fiscal policy shape corporate earnings. Understanding broad economic forces enhances company selection. Firms with pricing power often navigate inflation more effectively. Businesses serving essential demand may demonstrate stability during downturns. Strategic allocation across sectors accounts for these dynamics. Another realistic example involves a medical device manufacturer supplying hospitals across the United States. Demand for critical healthcare equipment remains consistent due to demographic trends and ongoing medical needs. If the company invests heavily in research, maintains regulatory compliance, and secures long-term supply contracts, earnings visibility improves. Investors reviewing patent portfolios, product pipelines, and hospital partnerships gain insight into durability. Ownership over extended periods aligns with long-term healthcare demand growth. Compounding remains the mathematical engine behind ownership strategy. Suppose an investor achieves an average annual return of 8% over 20 years through disciplined selection and reinvestment. $100,000 grows substantially through compounding. Extending that horizon to 30 years amplifies the effect significantly. The difference between consistent reinvestment and interrupted participation becomes visible in final portfolio value. Time magnifies disciplined decisions. Risk remains present in all equity investing. Market downturns can reduce portfolio value temporarily. Company-specific challenges may arise. Diversification, quality selection, valuation discipline, and long-term perspective mitigate these risks. Permanent capital loss typically occurs when investors ignore fundamentals or overpay for unsustainable growth narratives. Ownership strategy avoids speculative extremes and prioritizes measurable performance. Institutional investors across the United States often allocate substantial capital toward high-quality companies with strong balance sheets and durable earning streams. Pension funds, university endowments, and large asset managers conduct extensive research before committing long-term capital. Individual investors applying similar principles benefit from structured discipline even at smaller scale. Ownership logic remains consistent regardless of portfolio size. The psychological shift from saver to owner transforms financial perspective. Savings stored in low-yield vehicles struggle to outpace inflation over long periods. Ownership in productive enterprises participates in economic expansion. Companies hire employees, develop technology, expand facilities, and serve customers nationwide. Shareholders share in that productivity. This connection between enterprise and personal wealth creates alignment with broader economic progress. Long-term value investing. The ownership-based wealth strategy requires patience, research, diversification, and valuation awareness. It operates within the framework of American corporate governance, financial transparency, and capital market infrastructure. Investors who commit to disciplined ownership position themselves alongside companies building tangible value across industries. Wealth built through ownership rarely appears dramatic in short intervals. Its strength becomes visible over decades of consistent participation. Businesses continue operating each day, generating revenue, improving efficiency, and expanding reach. Shareholders who remain aligned with durable companies witness gradual expansion of value. The process demands focus and emotional steadiness, yet its foundation rests on measurable financial performance rather than speculation. Financial independence grows when income transforms into ownership of productive enterprises and remains invested through the full arc of economic cycles.